Moving on, the tech sector weighing on the broader markets as we wait for the onslaught of tech earnings, but that's not the only thing investors are watching. Of course, they're also waiting to see what Federal Reserve Chair Jerome Powell has to say about the path toward cutting interest rates. Our next guest says rate cuts could actually be more of a cause for concern than a cause for joy. Joining us now is Johan Grahn, Allianz Investment Management Head, ETF Market Strategist. Johan, good to see you. We want to get your thoughts on the Fed, Johan, but maybe listen, let's start with the news we're going to get after the bell, because we got big names reporting, Microsoft, Starbucks, AMT. Johan, I'm curious just what you make of what you've heard so far this earnings season, Johan. What have been some of your big takeaways?
Yeah, hey, it's good to see you, Josh. Well, I think the cool thing about this earnings season is the preemptive strikes that it seems to be happening throughout the market. And I know Microsoft has always been, a key component to the Mag 7, if you will, and it continues to be. It's really what you have seen today is some of the chips being taken off the table. And I think that's an indication of what you might want to expect to see in a couple of hours when they actually start reporting. And the bigger news there, I would say, is the ripple effect that it has across other companies, including NVIDIA. So clearly taking it on the chin now for a few days here. So I think you're going to see it percolate through. It's all about the expectations. I mean, no doubt these companies have been doing quite well and they have some lofty goals. AI will continue to be a big play. The question is when it's actually going to break through and create some productivity gains more broadly for the rest of the sectors and not just the big IT firms.
Well, and what is your view on that, Johan? Do you think that we are going to see, by some measures, and it sort of depends on how you slice it and dice it here, but I know some Bank of America data showed that stocks that beat have been outperforming the S&P 500 by a higher margin than they usually do, and even companies that miss aren't necessarily being punished as much. Do you think that people are looking for silver linings here?
So I think that's actually a relatively natural view right now, because you see companies come out and they do the reporting, there is a case to be made for why they should get punished more for missing. You've seen that play out in the European market, for example, much more so this quarter than you have in the United States. But you haven't seen the big key core firms. The tech comes back to the tech firms right now. It's almost all eyes are focused on that. And some of the firms that may have missed their targets to some degree, maybe not have been as punished previously, they might actually take some of that negative spill, if you will, coming on the back end of the reporting that's coming up. Could, of course, swing both ways, but I think it's a little bit of a wait-and-see game this time.
Johan, another theme I want to get your take on, and something we talk a lot about, is the rotation in the market. You had that CPI print, Johan, a few weeks ago, and investors started piling into the small caps. I'm looking at the Russell right now. It's up about 0.1%. I'm just curious, Johan, what you make of that rotation. You think it's real, it's going to stick, or do you think it's a head fake? Curious to get your take.
Well, I think it's a slippery head fake. Maybe I can put it that way, because it's priced in based on the expectation. And I know you wanted to talk about the Fed at some point too. It's priced in based on the expectation of the Fed starting to cut rates in September. So if it's a real rotation trade that you will see leading into these rate cuts, that's a bigger question, I guess. But whether this is going to be sustainable, it's up to Jerome Powell and the rest of the Fed members. The game is entirely focused on the lower expected rates that we are seeing potentially starting already in September.
Johan, do you think that if indeed they're cutting in September, it's not so much because inflation has normalized, although that seems to be part of the equation, but because they are concerned that we're going to see job growth starting to roll over a little bit more?
Yeah, so keep in mind, it's the two things that they've come back to over and over for years now. It's the inflation print, which we've seen coming down, and it's getting mitigated. And I think it's, whether that is due to the restrictive policy from the Fed or if it's just a natural progression as things are normalizing on the back end of the pandemic, that the jury might be out on that particular topic. But yes, as it relates to the confidence from Jerome Powell and the Fed, as it relates to the rest of the economy, that's where you can see like some of those potential cracks, if you will, showing up in the labor market. There's been a few prints now coming out that are pointing to the fact that things are softening off just a little bit. And if the Fed wants to be pricing, if you will, the gap between inflation and their actual rates to make sure that the economy is less restrictive, when the turn is taking place, that could be 18 months from now. Nobody knows, right? But that's what they're trying to do. And yes, is the short answer to your question. With this softening in the labor market, yes, that is giving them a great deal of confidence, I would say, to take some of the rate cuts, put them back on the table.
I'm just curious, though, Johan. I mean, traders seem to think that cut in September is basically a lock at this point. If they didn't get that, I'm just curious how you think the markets might react.
Well, I think they will get it because I think that regardless of where the CPI print comes in, it would have to be pretty violently mismatched with expectations for the Fed to change his mind based off of that. And I know you have some labor numbers coming in this week too, and they would also have to be incredibly out of whack, I believe, for the Fed to not actually start cutting. And I say that also based on history that we've seen in terms of how the Fed is acting and how they're taking action. It's been very, very consistent, and you've seen it throughout the season. As you get closer and closer, the combination of the market expectation and where Federal Chairman Jerome Powell is setting the expectation that he will, same thing that we will do tomorrow during his speech, it's always following the same pattern. So it's never a guarantee, but it's pretty close to a guarantee at this point. It's the same playbook that we've seen for a while, except now, of course, we're changing the tune by cutting instead of increasing or holding.
Yep, well, we'll see if he's singing that same tune indeed. Johan, thank you. Appreciate it.
Yeah, you bet. Thank you.